This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today our special guest is John Burns. He is the CEO and founder of John Burns Consulting. John founded the company to help business executives make informed housing industry decisions. The company research subscribers receive the most accurate analysis possible to inform their macro investment decisions. And the company's consulting clients receive specific property and portfolio investment advice designed to maximize profits. The team takes great pride in enabling the profitable development of the best places to live in the world. John co-authored Big Shifts Ahead, which we will talk about, Demographic Clarity for Business. John's one of the most sought after expert speakers in the real estate field today, and has a BA in economics from Stanford, MBA from UCLA, and he has been on our panel many times over the years that I survived. So John, thank you for that and welcome back.
And I'm a huge Bruce Norris fan.
Thank you very much. What's interesting, I always think about when people start a business or get into a field. And so you started the Burns Consulting in 2001, and you had been with other consulting companies before that. But for the run that you had, let's say from 2001 to 2007, in your first 6 years, builders just had a pretty good time, didn't they?
Yeah, the first few years, actually, the first year was a little rocky. There was this thing called a recession, and a 9/11 hit. But then 2003 and especially 2004 through 2005 were unbelievable, and it's feeling pretty similar right now.
That's interesting. Yeah, we're definitely going to get to what you look at to say we got to be careful here. What was the year? Because 2006, you invited me out to speak or debate in front of your group. And so, well, what year was it obvious to the builders that the volume that they were expecting would collapse? What year was that?
So it was 2006.
Wow.
I remember specifically Centex Homes in Sacramento was offering $100,000 off a $600,000 home the day after the Super Bowl. So it was like February 1st or something like that.
Wow.
But what I will say is that the suppliers and the trades and the other guys that were relying on the information to run their businesses, it was at least a year before they got it, and it was another 2 years before Wall Street figured it out, or really until Lehman Brothers blew up.
Right. Well, that was interesting because I didn't feel a very warm audience that night talking about the end of a cycle. So that was interesting.
I probably misspoke too. Builder stock prices peaked at the end of 2005. So Wall Street, in terms of putting your money where your mouth is, got it the timing right. It was just a lot of the analysts and things and the investment bankers and others didn't want to hear it. So the bullish case persisted until Lehman Brothers blew up.
So what's interesting about your business model is, so in 2006, 2007, 2008. Even 2009, if all you did was stand pat and say, all I do is consult for builders in their new projects, there's a good chance you wouldn't have been in business. So how did you switch gears to not only help people that were really hammered by the events of that downturn? Also, it seems like you probably got new clientele as well during that cycle.
Oh, big time. So I actually I felt like I knew what I was doing more in a down cycle than an up cycle, because I started in real estate in 1989 in Los Angeles.
Perfect.
and I worked for KPMG, which had a huge Japanese real estate practice, buying golf courses and doing all sorts of stuff.
Wow.
And, I was in my mid-20s and got to see the housing market fall apart in LA. And plug for you, you were the first, I think, who called it. And KPMG, fortunately for me, has a big financial services practice. So the banks and the distressed investors that came in and made a lot of fortune were KPMG clients. So I got to work for them during a downturn, and I really saw how much money was made. But then also related to starting my business, when I was at KPMG, we were working for commercial real estate and residential real estate. And the commercial real estate guys were just so sophisticated and knew when to step on the gas or take the brakes off. And we're doing a lot of analysis, and the residential market really was not. So that was really the crux of my business. I thought, well, gee, I can go do that for the residential guys and amortize the cost of it across a lot of companies. And that's what we've been doing.
Okay. Did you start to negotiate the debt that they had with the lenders during that cycle?
Oh yeah, big time.
Okay. Okay.
In fact, until recently, 2008 was our best year ever.
Well, that means you put on the right hats. That's all I can say.
We put on the right hats, but what happens for consultants is that when people who don't know the industry get involved in the industry, they need some help. And so that's, banks who never thought they'd be taking back $300 million unsecured loans, all of a sudden were. Distressed guys are coming in and from other industries and saying, I can see this industry is in distress. In fact, I won't mention names, but I'll give you one example. Is a very, very large, pretty famous debt fund made a huge investment in one of the public home builders who's no longer with us.
Oh, wow.
And then called me that evening after they made the investment and said, what are you doing for dinner? I said, I have dinner plans. I was in New York. And they said, okay, you're having dinner twice because you need to tell me what we just bought.
That's a little late, but my gosh. When did you first deal with Wall Street when they decided to get into the real estate buying business? And were they intentionally buying rentals at that point, or did they think they were buying flips?
You're talking about this cycle or last?
Yeah. No, well, the cycle where I would say 2008 and 9, whenever they joined the party of buying properties at trustee sales, let's say, or lender-owned properties.
I don't remember the exact year, but I remember when it started. So it was actually February 09.
Okay.
Where if you remember at the time, Congress was passing laws with $10,000 tax credits and all sorts of stuff to try to rescue housing.
Right.
And it didn't really seem to me like they were doing any sort of analysis. It was just kind of policy in a reaction. So I had met this guy who was formerly a treasurer, who was very well connected. And I said, well, why don't I just put together a deck of what's really going on in the housing market? Because that's what we do. And then you just set up meetings, and I'll just share with all these policymakers what I see going on in the market. I'll get some insight into what's going on with policy. It'll be great. And when I met with FHA HUD at the time, I think it's okay if I mention his name, Raphael
Bostic. Yeah, I know who he is. Yep.
Was one of the top people there.
Yeah.
And Raphael and I were talking this through, and we came to the realization that what is HUD and FHA doing here? We're going to allow, all these foreclosures. We're going to drive people out of their homes. We're going to be driving down prices on FHA by doing that as we sell these things. And then FHA is going to come in and provide rental assistance to these people. Up a rent. So we're like, why, wouldn't it be better for everybody if you just kept them in the house? If you have to turn them into a renter, that's fine. But everybody be better off if you didn't do this. And so Raphael said, that makes a lot of sense. I don't think the government's a good landlord. Can you go find somebody who's a property manager? And we're going to need some capital to pull this off too. And so I went around Wall Street in 2009 pitching that. A couple of my clients had, I mean, just pitching it to a couple of my clients as a favor to them. Two of my clients are three of the most famous people that made a fortune during the downturn shorting mortgages.
Okay.
One of them was very interested in taking his fortune and turning around and getting on the other side of this. But FHA, it just never, the government wasn't able to do it. So the story got written there. But I think when Blackstone and others decided to come in big a few years later, they had heard the story from 2009, and that's what kind of got us going.
Okay. So now that you can't buy houses below replacement cost, the build to, there you are. Let's see if I can start a video here. Can you see me?
Yes.
There we go. Yay. All right. Well, after all the below replacement cost houses left the building, and now you're involved in clients that are starting to look at rent to own, not only rent to own scattered homes, but rent to own start from scratch, build tract homes. So do you see that as a big player going forward?
That is a massive play going on right now. I think the capital seeking that is almost unlimited. So I won't mention which client this time, but we used to have this argument about what is replacement cost anyway, and that's your whole thesis and buying below replacement cost. And it was, it didn't take long before they were buying at replacement cost.
That's right.
Yeah.
We were competing against them, and we know that.
Right. But then, the big question is, what is the land value in that? And that usually fluctuates through the cycle. But anyway, there were a lot of skeptics, as you know, and I was skeptical too, because I'd never seen this before, that somebody could buy thousands and thousands and thousands of homes and manage them effectively like the apartment guys do, where they're all right next to each other. And I learned along the way that thanks to some new technology that basically was being developed at that time, you can make it work. So the model wasn't proven until really Invitation Homes did their first securitization, and then they went public, and American Homes for Rent went public, and everybody could see their financial statements and saying these guys are making money with homes scattered all over the Metroplex. Can you imagine what they would do if they were all the exact same house with the exact same refrigerator right next to each other?
And new. So there's going to, the CapEx risk is gone. And a third of renters rent apartment complexes, and we build brand new complexes for those willing to pay a premium for something new all the time. Why don't we build something for the 2/3 of renters that are in a single family rental home that have never had the opportunity to rent a new house, or it's very difficult. And even going a little further into that, as we did a lot of consumer research on this, if you're the renter in a neighborhood, the homeowner kind of snubs their nose at you a lot of times when you pull into the driveway. Right.
So now you're in with like-minded people, and nobody, you're all in the same boat. So I actually think it's a better experience in many, many respects than just renting a single family home in an owned neighborhood.
Let's talk a little bit about Big Shifts Ahead. You wrote that in what year?
2016.
16. And I read it in a day, and I have a feeling it took a long time to write.
9,000 painful hours of research.
I guess it must have been painful since you've carded the ball. But I know you're passionate about it though too.
Yeah, I didn't do all 9,000 hours, but my wife will attest it was many nights and weekends. It was a side job for at least a year.
Yeah. One of the keys in the books was renaming the generations and reducing the years that those groups represented. So why did you make that decision to do that?
Well, what I think we're pretty good at is taking complex stuff and making it simpler. And it just dawned on me that, we're comparing boomers to Gen X. One's 19 years, one's 17 years. Millennials, people can't even agree on the start and end date. And we're doing all these apples and oranges comparisons. And the analogy I used was Mark Zuckerberg, born in '84, and my daughter, born in 2000, were both millennials,
Right.
kind of in different stages of their lives.
Yeah.
And so we just went to, if you went to decade born, nobody's going to argue what year you're born. You're going to be comparing 10-year periods to 10-year periods. The time frame is going to get a little tighter, so you can really talk about this is the period of time where they're doing household formations or buying homes. We actually broke it down by year and then 5-year, and that was just too many breakouts. So we went with decade born.
Okay.
How many? So how soon do you start naming the new one? Because we're in the new decade now. So what is?
Yeah, so in 2016, we called those born in the 2000s the globals. So the youngest of which was 6. And I was sticking my neck out a little bit at the time, but every generation we gave a name for how we thought they were changing the world or changing how we live. And we just thought that group was going to be more sensitive to what was going on globally, not knowing they'd end up in a global pandemic probably during their most important formation year. So I think we got lucky on that one.
The Quarantinos, is that what you're going to call them?
I think that they're globals, but those born in the 90s were the connectors, because that's when we shifted to being connected 24/7 on cell phones, and they were also being helicopter parented. So there was a connection there. The group born in the 80s were called the sharers. They really developed the sharing economy, and they were doing Airbnb and Uber, and all those really cool companies were started by those guys to just share things so everybody could have nice stuff at less of a cost. And then we can go all the way back if you want. But
Well, the generation that I'm part of, let's talk about, there's people born in the 50s.
yeah,
So I'd like to just ask a few questions just as comparison. So percentage of ownership of a home for the innovators that were born in the 50s compared to the sharers of the born in the 80s. What percentage? And I know that we're older, so we own more, but do you have an idea of the same time frame, the percentage of owners?
I do. I don't have it up to date.
Oh, that's okay. Well, obviously it was a lot more of us owned homes. So how does sharers view home ownership in general?
So the way we did that is we looked at the ages of kind of 28, 38, and 48 as kind of your 10-year, 20-year, and 30-year high school reunion as a way to do the math on that, Bruce.
Okay.
And if I remember correctly, the 80s group was about 5 or 6% behind your generation at the same age, at the age of 28.
Okay.
However, they were also having kids 4 years later and getting married, I believe it was 5 years later. In fact, a lot of them having the kids first and then getting married.
Mm-hmm.
So I think some of that is a little bit misleading, because it's not just the age that's the impetus to become a homeowner, it's the change in life stage.
Okay.
So I actually was optimistic that not that they would completely catch up, but that some of that gap would be closed just as they moved into later life stage. And then actually, when you buy a home at 32 instead of 26, you're making more money. You're actually a little more able to buy a home. So
Okay.
I didn't think they were ever going to completely catch up, because I made a bad assumption that mortgage financing would not get looser or easier after Dodd-Frank. And I don't think the documentation's gotten easier, but clearly rates have gone down and FHA has taken a lot of market share. So some things have been much more favorable for home ownership than I envisioned.
What were some of the ideas in the big shift that you expected to see, some of the big shifts rather, that you expected to see after you wrote the book in 2016? So big shifts ahead, what shifts were you thinking?
Well, we came up with this rule called the 4-5-6 rule, which is how I help remember these things. I need acronyms. There were, as we studied all the generations and what caused them to form households and be homeowners, and there was a government policy that drove it. I mean, your generation was not that far after the GI Bill.
Right.
And the group before you were all vets because they were drafted. So everybody was a GI, that helps.
Sure.
So government policy, we thought Dodd-Frank was going to be much more stringent and much tougher to get a mortgage. So we were wrong on that. I never envisioned that the government would be printing money like it's printing now either. So we were wrong on that. But anyway, the reason I say this is if you look at the four policies, government policy, what the economy is, what new technologies are, which I already told you how that impacted the single family rental business, and societal shifts, like getting married later, going to college, having student debt. If you look at that across the 5 life stages, you come up with different conclusions. And people were generalizing, well, the economy is going to cause this to home ownership. Well, falling interest rates are going to cause this. Well, it's going to do something different to a young person who's buying their first home than somebody who already owns a home, than somebody's in retirement who thought they were going to live on interest income and no longer can.
Right.
So I think taking those 4 disruptors and looking at them by life stage allows people to answer the 6 questions, which is what, why, when, where, and how are people going to buy my products or rent my house.
And by the way, it's one of those books you have to have on your shelf. You don't just read it, you look at it whenever you want to answer a question about demographics. That's just really an important, it's like a encyclopedia. It was fun to read. Not very many people read that in a day, and I had a yellow marker, so it was pretty fun.
Well, it's got 100 color charts in it, so that we decided to make it easy to read.
Yeah, that was good. One of the things that I recall was that you thought there were going to be some demographic changes or migration changes. There were going to be states that grew more than they used to compared to states that were going to grow less than they are used to. So has that occurred, and what states were they?
Yeah, so at the time, I remember if you define the South as Nevada through Texas through Florida all the way up into the Carolinas.
Okay.
42% of America lived in that swath of the country, but 62% of the growth was going there. We believed that was going to accelerate, primarily because of those pro-growth policies in the South that were attracting jobs and homes being more affordable, and that has played out in spades, frankly.
Right.
But that wasn't earth-shattering. I think most people knew that was going to happen.
Why did I've talked a little bit about this, but looking at prices, we both have a kind of a historical perspective and charts. California was almost on par with the U.S. median price in '74, 34 grand to 31 grand, and then in a very short period of time, it doubled the national price, and basically it's been parked thereabouts, 170 to 210. Was that what drove that, and is that being unwound by losing migration constantly now? I'm just curious what your take is on that.
I think the main thing that drove that was supply constraints. I mean, there's an ocean on the west, so you couldn't expand west. Along coastal California, there's some mountains along the east. They just weren't making more land in LA and Orange County, and people didn't view Fresno and Bakersfield as acceptable places to relocate. Instead, they started relocating.
Okay.
And it was mostly, I think it was mostly supply. I called it the Manhattanization of California. I mean, Manhattan was very expensive in the 70s because of supply constraints. Same with California.
Do you think that's kind of still intact, right?
Absolutely.
Okay.
Absolutely.
Interesting. So California losing people on an annual basis now, which is basically even the migration that comes in is less than the migration that's coming out. California gains population only by birth over death right now.
Right.
But because of the constrained supply, you're not thinking they'll have a negative price event going forward because of the supply constraint.
Well, I mean, I wouldn't go that far. It was supply constrained during the last 2 downturns, and we had negative price events. So
Okay,
What I was answering is why it's essentially a permanently more expensive place to live. So,
Okay.
and it's always been, at least since 74, permanently more expensive than the rest of the country.
that's right.
So, but it can, because of that, I do think it can cycle harder because prices, when demand exceeds supply, prices can run up more quickly when you really can't provide supply. And that's the other difference in California. It's not just the lack of land to build on, but the extent there is land, the jurisdictions here make it very, very difficult and very, very expensive for the home builders to provide anything affordable.
Let's switch gears, and I want to talk about what you saw in coming for 2019. So let's say we were in January 2019, and I'll kind of give you my take looking at the charts, and again, being pretty familiar with it. We had record low unemployment, no foreclosures to compete with. Inventory levels were pretty normal, reasonable construction levels. Economy was growing, and it felt certain, kind of like you entered 2019 thinking everything's pretty good. And then at the end of the year, prices grew by a very meager percentage. And that surprised me because it was the same set of charts that we had in 87 and 04, which we did double digits. So what did you see at the beginning of 2019, and it play out the same or differently than what you thought?
So, and I'm a real contrarian on this. So I think in the middle of 29, and I've explained this many times and nobody agrees with me, so that's what a contrarian is. But if you look at the middle of 2019, and until the very end, we had 2.08 adults per household, which was the long-term norm. So you can't really say in terms of shelter, we were undersupplied.
Okay.
And home prices and rents were both growing at 3 to 4% per year, and incomes were maybe growing at 2 to 3. So I thought 2019 was a stable housing market, just boring, stable. We had a forecast for some similar numbers to what were going on. But the other piece of this that we calculated in 2012, I think it was, that we had overbuilt the country by 3.5 million units.
Okay.
And we kept building from 2012 to 2019 until eventually it took us a long time, but we got back to equilibrium vacancy, if you will. We had the right number. And I think it was in the middle of 2019 where all of a sudden I finally was the last person on board and said, nationally, we do have a supply shortage. Everybody been saying that forever.
That's right.
And they're still saying it now. And so you had a supply shortage that was starting to play out. The multifamily guys were building for it. We had a 30-year high in construction, so they could see it. And then rates fell. And that combination caused a pretty strong fourth quarter of 2019, but a really robust first quarter of 2020 until the pandemic hit. I mean, the housing market was much stronger than I had forecast. I mean, it was off to the races.
That's going to do it for part one of our interview with John Burns of John Burns Real Estate Consulting. Be sure to tune in next week for part two. Thanks.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.